Director of Business Development with Coldwell Banker Elite, and I'm here with Austin Wallace, attorney with Shaheen Law Firm, Frye, Branch Manager at Movement Mortgage, and Matthew Rathbun, Executive Vice President for Coldwell Banker Elite. And we're here to discuss the upcoming changes in August for CFPB, how the new disclosures will affect consumers, real estate agents, title companies, and lenders. First question is, can you explain to us what initiated the CFPB changes and why these were made in the first place?
The Dodd-Frank Act that was passed following the mortgage meltdown created the Consumer Federal Protection Bureau, which is the CFPB, with a mandate to try to clarify financial disclosures writ large, not only just mortgage lending, but also in the entire industry. And as a result, the rules that they promulgated in the past year to 2 years, and that'll become effective August 1st, are going to mandate the new consumer disclosure and loan estimate.
Okay, what types of transactions will this affect in the settlement mortgage industry?
It'll mostly, the definition contained in the rules actually defines any federally related mortgage or money. So that's basically any loan, closed-end consumer transaction. So the better way to think of it is what doesn't it include, which would be cash transactions, home equity lines of credit, commercial transactions, reverse mortgages, mobile financing, mobile home financing is not included. Everything else would fall under the regulations.
And what are the new forms and what old forms are they replacing, and who will be preparing those forms?
So the new forms are going to be the loan estimate and the closing disclosure. The loan estimate will replace the previous good faith estimate and truth in lending statement that the borrower receives at application. And the closing disclosure will actually be replacing the truth in lending at closing and the HUD-1 settlement statement. So those are the forms that are being replaced. So it's basically taking 4 forms and putting them into 2 forms.
Okay. What do you see are the biggest challenges that could cause a closing delay, and should agents be concerned?
I'll take the agents being concerned part. I think that the agents do need to be concerned about the 3-day time frame that's going to be affiliated or associated with this, but not really so much if they're using good settlement companies, good lenders who are prepared for this. And even right now, we're a few months out from it, and there's already lenders and partners that we have that we know have taken some initiative to start some internal processes, get the word out, understand it better, and make sure the agents are informed. So feeling a little bit better about this. I do think we're going to have some bumps, and Austin and Heather can speak to this, but doing a settlement in that August-September month is probably going to be something we need to expect delays in.
Yeah, so I think the biggest thing that's changing outside of the disclosures themselves is going to be that all of the closings have to have the new closing disclosure, which we would know today as the HUD-1. That has to be out to the borrower 3 days prior to closing. That outside of the forms is going to be the biggest change. So with that being said, that clock does not include any part of the weekend, doesn't include Saturdays or Sundays, it doesn't include any holidays. So in some cases, it may have to be 5 days before closing that this has to be there. That could cause some delays, for transactions where today we're used to getting a file into closing and sometimes delivering a HUD-1 an hour before closing to the borrower. That's going to be a thing of the past, and all of that stuff is going to have to happen, days in advance. It sounds really scary, but honestly, things can still change after that disclosure has gone out to the borrower. The things that cannot change, because there's 3 things that can't change, are the APR cannot increase by 1/8%. The loan program itself cannot change, and what's the third thing? Because I'm drawing a blank.
Well, they can't change the loan amount or the prepayment penalty.
Prepayment penalty. Prepayment penalty cannot be added to the loan after that closing disclosure has gone out. So those are the only 3 things that will trigger a redisclosure at that point. So, if you're doing a final walkthrough and something comes up on that final walkthrough, that doesn't mean the process stops and you have to redo this closing disclosure and wait 3 days. Anything that's discussed or needed with that typically won't change your APR, won't change your loan program, and won't add a prepayment penalty. So I know that a lot of agents in some roundtables that I've done have said, well, what happens at the walkthrough? Do we have to now do the walkthrough 5 days in advance, and that becomes a liability? No, it doesn't, because if you do the walkthrough and something hasn't been addressed, you can still put that stuff on there. Those things can still change without having to wait the 3 day for redisclosure.
There is one sort of gray area in some of the regulations. As Heather said, the 3 day disclosure period is only triggered by those 3 changes in the loan. But there is some language in the regulation that says that any change in the closing disclosure prior to closing, so if there was a walkthrough and there was some credit or invoice that was going to be paid pursuant to the walkthrough, any change in the settlement statement or closing disclosure has to be done a business day before closing. That wouldn't require a new 3 day disclosure period, but it may mean that closing has to happen a business day later. We've gotten conflicting information from different lenders, different people at the CFPB on how that's going to be interpreted. So it's going to that's going to be the shaky area coming August, September, and October as to how that's going to affect a walkthrough.
I think from a practical standpoint for the agents as well is, when your closing date is going to be when you propose and write the contract. You should go to your Outlook calendar, your Gmail calendar, and put 3 business days prior to closing when this disclosure is supposed to be delivered and approved. I think we're all going to have obligations as teams between settlement attorneys and mortgage lenders, the 3 of us, to make sure that we're watching our days and watching these things. And even as we're doing this video, even as we're discussing this, Congress is making a play to take this entity and make more governance out of it, put a new layer of between them and administration. So some of this could still change even before that date. But for now, we know the dates, we know the times, good practices, checklists, and working as a team with our vendors is going to be.
I think the key too is to build in flexibility.
Yeah.
So if you know that all of this stuff has to happen prior to closing, but you've got a client that's planning on moving the day of closing, the day after closing, you really should have some sort of other setup in case things get delayed, so that they're not sitting in our parking lot in a moving van expecting to move in that day, and then everything has to be redisclosed. So some form of plan B if things get delayed would be very a good idea. The other thing, well, never mind. I had a thought, but I forgot it.
Okay, well, one of the other things, even for agents, as we're drafting the agreements and the offers to purchase, would be to put language in there covering your buyers. So we know Move Mortgage is ready. We know some lenders are ready, but many aren't. Many are that have notoriously had issues with deadline, or just is going to make it more complicated. But some type of protection in the offer to purchase, so that when we write it, that the seller is aware the closing date is still contingent on compliance with CFPB. I mean, the forms speak to CFPB, they speak to this issue, but I hate to see some of our buyers be put into default positions because they didn't have a lender who wasn't compliant or was capable of meeting the compliance issues.
Well, on that thought, what are lenders currently doing to prepare for August?
So it just depends on the lender, obviously, but I think for the majority, most lenders are trying to prepare themselves in some form or fashion. I have heard, from some other companies that they're not even going to accept 30-day contracts. They're going to require 45 days until they figure a way through the process to make sure that they're meeting the dates, to set the expectations properly up front. Movement Mortgage have already developed a department called pre-closing, and they're already taking files and implementing the changes and doing the new disclosures now on loans, just so they know what to expect when the date comes, so that they can be prepared. I think one of the other biggest challenges is that the CFPB says the lenders are going to be held responsible for ensuring that they're compliant with the 3-day disclosure period, with the forms themselves, that the lenders will be held completely liable. With that being said, they also said settlement attorneys and title companies can help them prepare those forms, but all of the liability still falls back on the lender. And so with that being said, I think there's really kind of this gray area right now, because I don't think anybody really has come out and said, this is how we're going to handle it, and each company can handle it differently. Mm-hmm. Not all lenders are going to prepare it, not all title companies and attorneys are going to prepare it. The lender has the discretion to decide whether they want to prepare it or whether they want to put that on the settlement agency. So I think that's still kind of being worked out among different companies as to how they want to handle it and you know, what their approach is going to be.
One thing that I'd forgotten earlier was that 3 days doesn't really mean 3 days. The rules actually require if you're going to mail the disclosure to the borrower, they assume a 3-day delivery period of time. And then the borrower has to have 3 days to review the settlement statement. So if a lender is going to mail, and many of the large lenders have told us that they plan on snail mailing the disclosure to the borrower, that's a 6-day period of time that they have to have that settlement statement to the borrower before a closing can happen. The rules allow for electronic disclosure, and I would have assumed that the majority of lenders would have gone that route, but many have told us that they're going to mail it. So that's going to be a 6-day period that would potentially delay a closing if there was a change in the terms.
Yeah, I mean, and so to Heather's point about the 45-day closing, to your point about whether or no we know they're going to be snail mailed or not, 60-day closings, at least for the first couple months, should be pretty much the standard if agents are writing this. And hopefully the agents on the opposing side of a transaction will know and have similar training to what we're doing and discussing here, so that everybody understands 60 days should be the norm for a while, at least.
Which makes my stomach turn.
Well, yeah, I mean, none of this is great, but it is, and it's safer to do the 60 days, I think,
Yeah.
and say we can close sooner if everything else is in order.
Right.
We've still, to this day, and for over a decade that I've been doing this, that whole lender commitment letter comes the morning of closing, and that seems to be a struggle to get. So now asking for 3-day disclosure or 6-day if they're putting it in the mailbox is risky. And the fines are far too high to risk.
Yeah.
Not trying to be prudent.
So what should our agents and brokers do to prepare for this, and also settlement companies prior to August?
Yeah. So, well, the first for agents and brokers, we make sure that our partners like Move-In and like Shaheen, that we know what they're asking for, and we're writing to those things. Any vendor that we recommend to our client, we should check to make sure they have processes in place. But again, mark on your calendars 3 days prior to closing. Write in the offer to purchase if you're the selling agent that the buyer shouldn't be liable for failure to comply with CFPB timelines. We don't want them being placed in default because of that. And better education for our consumers. For brokers, we should have some type of one-page quick notice to the consumers about what the changes are and why we expect to be having delays from August to probably January 1st of next year.
Some other things to consider too is that some of the lesser talked about rules are that any reference to owner's title insurance is going to be referred to as optional. My expectation is that both agents, brokers, and settlement agents are going to get a lot of phone calls trying to explain the difference between owner's title insurance and lender's title insurance. So being familiar with those differences would be very useful. And just familiarizing yourself with the new closing disclosure, because I would imagine that your clients are going to end up calling and saying, what is this 5-page behemoth? Where is stuff on here? And so being able to direct them in that direction is going to make you look a lot better.
It does look very different than what you've seen before. So I think just looking at a copy and really understanding what the closing disclosure looks like and what it's saying is going to be helpful. It's going to start off with page 1 showing payment information instead of a breakout of settlement cost. So it's going to be very different. There are no more line numbers. Everything's categorized with alphabetical letters, and so that's going to be very different. And just it all around looks different. There's different information on it. So yeah, I think that familiarizing yourself with the form itself is going to be helpful.
One saving grace to all this, though, is that it appears as though the new closing disclosure, at least for settlement, is just going to be superimposed upon what we already do for settlement. In other words, the new closing disclosure has no place for a seller to sign. And in fact, the seller's not even required or allowed in many instances to receive it. So that closing disclosure is directed solely to the buyer. And so as settlement agents dealing with both sides of the transaction, we're probably going to end up preparing a settlement statement, much like we do right now, that will have both sides of the transaction and that everybody will be familiar with. And so that will come at settlement or right prior to settlement. And everybody will be familiar with that and know where the money's going. So it'd be nice to know and be familiar with the closing disclosure, but it's not the end of the world if that's not something that you're that familiar with. That'll come with time.
Well, and even the loan disclosure, this replacing the good faith estimate, I mean, it's intended to be portable, so you can take it to another lender and say, here's what I'm getting, can you do better? I mean, that was is part of what I think the intent was. So for our agents, we need to be cognizant of what are the repercussions if they do that. Heather could speak better to maybe if there is any credit repercussions, or shopping around. Our contingencies and our standard forms using the Northern Virginia contract allow the buyer to change lenders and terms, but they may lose the protection of the contingency if they don't get the seller to capitulate, sign a new addendum, allowing them to change an early notice. So taking that document and finding a new loan officer 15 days before a 60-day closing with all these other things could be very detrimental to the client. So agents are going to have to be,
And I think primarily the point, I mean, this whole change is consumer driven. So that consumers understand what they're signing at closing. And I think with that being said, one of the biggest things is that 3-day window for them to receive and review the new closing disclosure is going to allow them, from the comfort of their home, the opportunity to really look over everything that they're signing. It's going to allow them the opportunity to make sure that the terms they discuss with their lender from the beginning is actually the loan that they're getting. And I think a lot of times, even in today's state of disclosures and things like that, they're quoted something up front from a lender, but by the time they get to closing, a lot of that stuff is changed. But now they're under the gun. They're in a room full of people expecting them to sign. They know if they don't sign, they don't get the house. They really don't have the opportunity to look over this stuff and really understand it. So, I mean, from a consumer standpoint, this 3-day window is going to allow them the opportunity to look at that information, make sure it's everything that they were promised, everything that is okay, and they're comfortable with the terms before going to closing with a room full of those people and signing their life away, per se, for that kind of decision. So I think that it's great for the consumer. It's definitely going to cause some backlog and probably some issues at some point in time for all of us, but for the consumer, I think that it's a good opportunity for them. Now, if they decided at that point to change lenders, it's probably going to really cause some major problems. I mean, again, you have to start the process all over. I don't foresee that the lender may change at that point, but what I do foresee is if the terms are wrong or there's something there that they're not happy with, having to wait until that's rectified, redisclose, and then close. So, I mean, it's not going to be as quick as it can be now where they get to closing, they're not happy something with the HUD, they call the lender, a couple of changes are made, a new package is sent out. I mean, all of that can be done in a couple hours. That's going to go by the wayside completely, and if anything is wrong, we're going to have to wait even longer before we can close. So I think that those types of issues could, arise if something's wrong with what they see on those papers.
And if there is something wrong in those papers, the agent should understand how to read the basic document, understand what we can and can't speak to. So if it's something with the settlement fee or the interest rate or APR is incorrect, we need to refer that back to the parties who issued those numbers and not try to decipher what those are. I mean, now we're helpers. That's our nature. That's our advocacy requires it. But with these documents, the changes that you may see may be substantial enough to be a liability if we were to speak to them. So.
One sort of just logistical issue is that the guidance from the CFPB is that when that closing disclosure is given to the borrower, it's not to be given to the real estate agent or the seller. So you as an agent may not be receiving this very settlement statement or closing disclosure that your client is. So prepping them ahead of time to say, hey, this is what's going to happen. You're going to be receiving this. If you could forward it to me afterwards, that would be great, because then we can go over it together and compare this to what we were supposed to be getting and what the contract provides for and the like.
And I think also just to touch on the snail mail portion of sending the disclosures out, through regular postal mail. Again, that's going to be lender discretion. I will say that a lot of lenders, like Movement Mortgage, have gone to e-sign disclosures. So our entire packages at this point, are e-sign, electronically signable, except for a few forms, which typically are your government or, IRS forms, things like that. We're required now as a lender that within 3 days of application, we have to disclose to the borrower the good faith estimate, the truth in lending. There are certain things within 3 days right now that we have to disclose to them. moving forward after August 1, there's still certain information we have to disclose within that 3-day window. We are allowed to do that electronically, and we do so. If those documents are not accessed by the email address that's provided to us, we know that. We can see when they're accessed. If they're not accessed within that 3-day window, we have to then send them out through regular mail. So I have to assume that with these changes, it will be very similar. We send them out. It's probably going to be time-stamped of accessibility. If they're not accessed, then we have to, at that point, send them through regular mail and still wait that same time period. So I can't say that everybody's going to send it through the mail. We are a paperless company. I can't imagine we're going to be sending stuff through the mail, but there will be cases where we have no option. So.
And I have heard from agents already who are upset because they won't get a copy of the good faith estimate. We're not getting that now. I mean, that's not.
Right.
It'd be great if our partners were to send that to us when they send it to our clients, but it really doesn't have much of an impact on what we're doing.
Right.
Now, the summit, the
Closing
closing
disclosure,
disclosure, much more important for us to review and make sure the numbers are accurate. But there again, it doesn't matter if I get it in 3 days as long as I get it before closing.
And to be quite honest, the good faith estimate currently is the most hard to read,
Yeah,
illogical
I agree.
form that I've ever seen in my life. I mean, consumers never understand it. It's one of those things where every single lender has their own version of a financial breakout, and they provide that to the consumer so that they understand what the numbers look like. The current good faith estimate only discloses charges and fees. It does not take into consideration earnest money that's already been given, credits from the sellers, what of those fees are going to be financed. So when a consumer gets the good faith estimate now, they always freak out and say, what are all these charges? I mean, I can't bring $15,000 to closing, and we as lenders have to explain, no. Those are just the charges. Let me show you this form, because this form actually explains to you how the credits are broken out and what you're actually going to bring to closing. So personally, I think the loan estimate is a good idea. I think that changing that GFE form, which is just very hard for a consumer to read, is going in the right direction. Hopefully it all goes smoothly, but I think that the form itself is much easier for consumers than the current good faith that we have now.
I love the fact that she hopes it goes smoothly, yet we have the president and Congress still bickering about who's going to be in charge of it a couple months out from the release.
Movement's not requiring 60-day closes. I mean, we're going now so that our stuff's a week before closing to make sure we can still hit that 30 days. So, you don't have to put 60 days in my contracts.
There you go. What other implementation issues are you guys expecting?
I think we've mostly touched on the ones that we're anticipating. The other one that we haven't sort of touched on is the CFPB has rather arbitrarily decided that all the information contained on the closing disclosure, and I guess for that matter the loan estimate, is containing non-public information, and therefore must be transmitted to the consumer via secure email. Most lenders have already been doing this to some degree, but most settlement agents have not been using that, and so now virtually every settlement agent, when they transmit, if they are charged with transmitting the closing disclosure, will do so along with a fair amount of other information using secure email. So the clients and the agents are going to be receiving a whole lot more emails via secure email. That poses a bit of a problem when you're accessing on the road on a cell phone, because you have to log in with your password and all that kind of stuff. So that's going to be a bit of an implementation challenge, just physically retrieving it. We've been trying to do it more often and try to train our clients to be using it. We've had a lot of pushback just because it's 3 or 4 extra steps just to retrieve what we've emailed. So I would imagine there'd be a lot of confusion and or consternation on the part of borrowers having to go through all this extra hoops to get there.
I know you're moderating. I'm going to ask a question here. It comes to mind. Just yesterday, I know with the client, we've seen the secured email system that some of the lenders are using be very problematic for AOL and Yahoo and MSN users. There's free email accounts with the exception of Gmail, which seems to work with everything. And it's throwing the consumers for a loop. So what they do is forward it to their agent, or we get copied on it. Now I'm concerned about whether or not we should be forwarding or emailing the client this information without a secured system.
To open the actual documents on our end as a lender, there's nothing to open the email. It's all about the information that they put in once it's opened. And once they type in, typically it's like property state and their social security number, at that point they open. So I don't think that by you getting it and forwarding it to them is any problem on our end, because they have to have that information in order to even open it. So
The solution that we're using allows for you pulling it up physically from the email by typing in the password or whatnot. But if that doesn't work because you're using AOL or whatever, you can then go to a website
right.
that we maintain that allows you to type it in on a regular browser.
Yeah, I think for us, though, if for some reason we have consumers who aren't tech savvy enough to do that,
Mhm.
Yeah.
then probably delivering only through DocuSign Transaction Room or whatever system we have that's secure can be our best bet.
Option.
Yeah.
Yeah.
Okay.
Well, thank you, everybody. I think that was very helpful, and I'm sure we'll be seeing more changes. So as changes come, we'll keep you up to date.
Thank you.
Thank you.
Thank you.